Hello student, welcome to the lecture on financial restructuring, and after this lecture we will be able to learn the following objectives. Discuss the rationale for diversification, describe the techniques for corporate restructuring, explain the mergers and takeovers, understand the business alliances. Financial restructuring is the restructuring of the financial assets and liabilities of a business in order to make the most beneficial financial environment for the corporation. The process of financial restructuring is often related with corporate restructuring in that restructuring the general function and work of the business is likely to impact the financial health of the company. Financial restructuring may mean refinancing at every level of capital structure, including securing asset-based loan, securing mezzanine and subordinated debt financing, securing institutional private placement of equity, achieving strategic partnering, identifying potential merger candidates. Concept of corporate restructuring. Corporate restructuring is one of the most complex and fundamental phenomena that management confronts. It is an episodic exercise not related to investment in new plant and machinery which involved a significant change in one or more of the following: pattern of ownership and control, composition of liability, asset mix of the firm. It involves significant reorientation, reorganization or realignment of assets and liabilities of the organization through conscious management action to improve future cash flow stream and to make more profitable and efficient. Meaning and need for corporate restructuring. Corporate restructuring is the process of redesigning one or more aspects of a company. The process of reorganizing a company may be implemented due to a number of different factors, such as positioning the company to be more competitive, survive a currently adverse economic climate, or poise the corporation to move in an entirely new direction. Restructuring a corporate entity is often a necessity when the company has grown to the point that the original structure can no longer efficiently manage the output and generally interests of the company. Forms of corporate restructuring. The type of restructuring depends on the elements of the business being affected and the reason that the restructuring is occurring. Internal restructuring. Internal restructuring typically occurs as a result of business analysis that shows a need for greater efficiency in the way business departments communicate and complete tasks. Financial restructuring. Financial restructuring deals with all changes the business makes to its debts and equity, including mergers, acquisition, joint ventures, and other deals. Generally, these occur when a company joins or is bought by another company. Technological restructuring. Technological restructuring occurs when a new technology has been developed that changes the way an industry operates. This type of restructuring usually affects employees and tends to lead to new training initiatives along with some layoffs as the company improves efficiency. Restructuring methods. Restructuring methods are typically divided into expansion, refocusing, corporate control, and ownership structure. The last two, corporate control and ownership structure, apply mostly to financial changes and affect ownership. Characteristic of corporate restructuring. To develop the company's balance sheet, to attain staff reduction, changes in corporate management, outsourcing of functions such as payroll and technical support to a more efficient third party, moving of procedures such as manufacturing to lower cost location, reorganizing of functions such as sales, marketing and distribution, renegotiation of labor contracts to reduce overhead, refinancing of corporate debt to decrease interest payments, a major public relationship campaign to reposition the company with consumer. Techniques for corporate restructuring. There are several restructuring methods. Joint ventures. Joint ventures are new enterprises owned by two or more participants. They are typically formed for special purposes for a limited duration. It is a combination of subsets of assets contributed by two business entities for a specific business purpose and a limited duration. Reasons for forming a joint venture: build on company's strength, spreading costs and risk, improving access to financial resources, economics of scale and advantages of size, access to new technologies and customers, access to innovative managerial practices. Spin-off. Spin-off are a way to get rid of underperforming or non-core business divisions that can drag down profits. Process of spin-off. The company decides to spin off a business division. Parent company files the necessary paperwork with the Securities and Exchange Board of World (SEBI). The spin-off becomes a company of its own and must also file paperwork with the SEBI. Shares in the new company are distributed to parent company shareholders. The spin-off company goes public. Split-off is a transaction in which some but not all parent company shareholders receive shares in a subsidiary in return for relinquishing the parent company's share. Feature of split-offs is that a portion of existing shareholders receive stock in a subsidiary in exchange for parent company stock. Sell-off. Selling a part or the entire firm by any one of means: sale, liquidation, spin-off, and so on. A general term for divestiture of part or all of a firm by any one of a number of means: sale, liquidation, spin-off, and so on. Divestitures. Divestiture is a transaction through which a firm sells a portion of its asset or a division to another company. It involves selling some of the asset or division for cash for securities to a third party, which is an outsider. Divestiture is a form of contraction for the selling company, means of expansion for the purchasing company. It represents the sales of a segment of a company, assets, a product line, a subsidiary, to a third party for cash or for securities. Equity carve-out. A transaction in which a parent firm offers some of a subsidiary's common stock to the general public to bring in a cash infusion to the parent with a loss of control. In other words, equity carve-outs are those in which some of a subsidiary shares are offered for a sale to the general public, bringing in an infusion of cash to the parent firm with a loss of control. Leverage buyout. A buyout is a transaction in which a person, group of people, or organization buys a company or a controlling share in the stock of a company. Buyouts, great and small, occur all over the world on a daily basis. Features of leveraged buyout: low existing debt loads, a multi-year history of stable and recurring cash flows, hard assets that may be used as collateral for lower cost, secure debt, the potential for new management to make operational or other improvements to the firm to boost cash flows, market conditions and perceptions that depress the valuation or stock price. Management buyout. In this case, management of the company buys the company and they may be joined by employees in the venture. This practice is sometimes questioned because management can have unfair advantages in negotiation and could potentially manipulate the value of the company in order to bring down the purchase price for them. Benefits of management buyouts. It provides an excellent opportunity for management of undervalued costs to realize the intrinsic value of the company. Low agency costs. Costs associated with conflict of interest between owners and managers. Source of tax savings. Since interest payments are tax deductible, pushing up gearing ratios to fund a management buyout can provide large tax covers. Employee stock option plan (ESOP). An employee stock option is a type of defined contribution benefit plan that buys and holds stock. ESOP is a qualified defined contribution employee benefit plan designed to invest primarily in the stock of the sponsoring employer. Features: Employee Stock Ownership Plan (ESOP) is an employee benefit plan. The scheme provides employees the ownership of stocks in the company. It is one of the profit sharing plans. Employers have the benefit to use the ESOPs as a tool to fetch loans from a financial institute. It also provides for tax benefits to the employees. Expansion techniques. Most successful businesses adopt a proactive approach to their domestic growth and their international ventures with careful business planning and strategy for the management and operations of such business expansion and development. Our business expansion planning program focuses on the long-term development of a business into a multinational or global enterprise. Mergers and takeovers. Business and economics theory suggests that mergers and takeovers will produce synergies, economics of scale, lower unit costs, and increase in market share and higher profit levels. Evidence shows that around 60% to 70% of takeovers and mergers fail to benefit the acquiring business and its shareholders. Most failed takeovers and mergers suffer from poor implementation, and the different cultures of the businesses are not taken into account by senior management. The merging of the cultures of businesses takes time, which senior management often does not have, especially after a takeover or merger has taken place. For merger or takeover to be successful, synergy needs to be attained, which means the new business that is formed must provide better performance and returns than would be gained if the business was separated. Advantages of mergers and takeovers. The main reason a company looks to merge or acquire another company is to increase shareholder value. This can be done for a number of reasons as follows. Synergy. This refers to the fact that the combined company can often reduce duplicate departments or operations, lowering the cost of the company relative to the same revenue stream, thus increasing profit. Increased revenue or increased market share. This motive assumes that the company will be absorbing a major competitor and thus increase its power to set prices. Business alliances. A business alliance is an agreement between businesses usually motivated by cost reduction and improved service for the customer. An example of this is quote sharing in airline alliances. Many, if not all, large airlines participate in one or more business alliances. Following are the 5 basic types. Sales alliance, an agreement to sell products or services that complement one another. Solution specific, an agreement to develop and sell a particular business solution together. Geographic specific, an agreement to market products and services in a particular geographic area together. Investment, an agreement to combine funds for shared investment. Joint venture, an agreement to share control, profit and loss in a particular economic undertaking. Strategic alliance. A strategic alliance is a partnership between businesses in which we combine efforts in a business effort. The joint effort can involve anything from getting a better price for goods by buying in bulk together to seeking business together with each of us providing part of the product. The basic idea behind strategic alliances is to minimize risk while maximizing leverage in the marketplace. Marketing alliances. A marketing alliance is an agreement involving 2 or more companies to share cost and resources to promote each of the companies within the group. The target markets of the companies within the alliance usually share similar characteristics. The alliance can be a formal or an informal agreement. Partnership. A partnership is a legal agreement between 2 parties wherein both the parties agree to share profits and losses of a common business with no anticipated end date. Collaborations. A collaboration is when 2 or more businesses come together to share resources to create greater efficiencies such as the sharing of employees, equipment, shipping costs, rent, products, etc. Collaboration are generally for specific time periods and resources. Foreign franchises. Franchising is defined in the measures as a contractual relationship whereby a franchisor grants a franchisee the right to use its business resources such as its trademark, trade name, business model, etc., and the franchisee operates under a uniform operational system and pays a franchising fee to the franchisor in accordance with the stipulations of the contract. Intellectual property rights. The importance of intellectual property in global is well established at all levels, statutory, administrative and judicial. Global ratified the agreement establishing the World Trade Organization (WTO). This agreement, inter alia, contains an agreement on trade-related aspects of intellectual property rights (TRIPS), which came into force from 1st January 1995. It lays down minimum standards for protection and enforcement of intellectual property rights in member countries, which are required to promote effective and adequate production of intellectual property rights with a view to reducing distortion and impediments to international trade. The agreement provides for norms and standards in respect of following areas of intellectual property. Patents. The basic obligation in the area of patents is that invention in all branches of technology, whether products or processes, shall be patentable if they meet the three tests of being new, involving an inventive step, and being capable of industrial application. Trademarks. Trademarks have been defined as any sign or any combination of signs capable of distinguishing the goods or services of one undertaking from those of other undertaking. Such distinguishing marks constitute protectable subject matter under the provision of the TRIPS agreement. Industrial design. Industrial design refers to creative activity which results in the ornamental or formal appearance of a product, and design right refers to a novel or original design that is accorded to the proprietor of a validly registered design. Industrial designs are an element of intellectual property. Summary. Let us now summarize what we have learned in this section. Corporate restructuring is one of the most complex and fundamental phenomena that management confronts. Corporate restructuring may also take place as a result of the acquisition of the company by new owners. Trademarks have been defined as any sign or any combination of signs capable of distinguishing the goods or services of one undertaking from those of other undertakings. Franchising is defined in the measures as a contractual relationship whereby a franchisor grants a franchisee the right to use its business resources such as its trademark. A merger can be seen as a decision made by two businesses that are broadly equal in terms of factors such as size, scale of operation, customers, etc.